Good afternoon, everyone. It's a pleasure to have you all here today. This is our press conference for the U.S. Article 4 consultation for 2026. We hope you have had a chance to review the concluding statement, which was placed under embargo. And I am delighted to be here with our Managing Director, Kristalina Georgieva, and our U.S. Mission Chief, Nigel. What we'll do today is we will start with Kristalina. She will share with you through opening remarks her takeaways from her meetings that concluded earlier today, and then we'll have time for some questions. We have 30 minutes for this press briefing, and I will now turn to Kristalina for her opening remarks.
Thank you very much, Julie, and great to have you all in the room and online. We have held meetings with Secretary Bessent and Chair Power today. Very good meetings, very substantive. And I want to start by expressing our gratitude to the leadership and staff of U.S. Treasury, the Federal Reserve, and other agencies for multiple discussions they have had with our team over the past several weeks. Secretary Bessent particularly underscored the value he places on frank, candid, and even-handed surveillance by the IMF. In our concluding statement, we note that U.S. policymakers have embarked on a systemic reorientation of the U.S. economy to boost the living standards of the American workers. The administration aims to do so by increasing economic self-reliance, supporting domestic manufacturing, reducing the trade deficit and reliance on foreign-produced goods, investing in domestic energy output, securing the border, and scaling back the federal government's role in the economy. Our consultation for 2026 focuses on the macroeconomic effects of this important shift in policies, and on that I would like to make 4 points. First, we expect that a buoyant U.S. economy will continue to grow strongly both this and next year. In 2025, growth reached 2.2% on a fourth quarter to fourth quarter basis, and this is close to our January 25 projection, despite significant swings in trade during the year and a sizable drag from the government shutdown in the fourth quarter. Unemployment has remained relatively low. The rate of participation in the labor force by prime-age workers has been rising, and real incomes have been increasing, and this is all good news. Undoubtedly, the story of 2025 has been the remarkable performance of U.S. private sector entrepreneurs and workers. The level of innovation, adaptability, and resilience has been impressive. The U.S. sits solidly at the frontier globally in terms of dynamism, know-how, and technology, and this has been most clear in the strength of labor productivity. It has helped to support growth in the United States and also to create positive spillovers to the global economy. And there is an upside risk that technology, investment inflows, and the administration's focus on reducing red tape will bear fruit, and they would support greater economic dynamism and growth. At this stage, it is difficult to quantify the potential of this impact, so we will have to continue to monitor these factors, how they impact growth in the United States carefully. So what do we expect? We expect the economy to accelerate somewhat in 2026, growing at a healthy 2.4% on a fourth quarter over fourth quarter basis, and to continue in similar pace into 2027. We also expect unemployment rate to fall somewhat to around 4%. Finally, inflation has remained around 3% throughout 2025, although services inflation has been steadily falling. Goods inflation has been somewhat affected by tariffs, but we expect that to wane and for inflation to return to the Federal Reserve's 2% target by early 2027. Given this inflation outlook, we believe it was appropriate for the Fed to cut interest rates during 25 and to return monetary policy to broadly neutral settings. Second, we see the near-term risks to activity, unemployment, and inflation as broadly balanced. The Fed has been calibrating policy well to the balance of risk between inflation pressures and slowing job growth. Under staff's baseline outlook, bringing down the federal funds rate modestly to between 3.25 and 3.5% by end 2026 will be consistent with an economy returning to full employment and inflation setting around the 2% target. A larger monetary easing than the one I described would need to be based on a material worsening in the outlook for the labor market. This is not in our baseline, but we recognize it is nonetheless a risk. Of course, what I'm telling you is just a forecast. Much could change in the coming months. We know that we operate in an environment of higher uncertainty. And as a result, the Fed will need to be attentive to incoming information and should continue to communicate their evolving views clearly to the public. Third, the continuing rise in public debt remains a concern. This is something we have been highlighting in previous Article 4s, and it is important to note that it remains a major issue to be attentive to. Good news, in 2025, the federal deficit did decline. However, we believe that even though the fiscal changes put in place in 2025 will provide a modest near-term boost to activity in 26-27, they will also raise the deficit. And indeed, what we expect is both federal and general government debt to go up, with the latter reaching 140% of GDP by 2030. Putting public debt on a decisively downward path will require determined actions in line with Secretary Besant's views on lowering the federal deficit. We have some recommendations in this regard, considering a broad range of policies to raise tax revenues and address structural imbalances in programs such as Social Security and Medicare. And let me go to fourth, say a few words about tariffs. We share the administration's concern about the size of the U.S. trade and current account deficit. This imbalance needs to be addressed, and doing so will benefit the US and it will benefit the global economy. We also recognize that more needs to be done to eliminate the various policy distortions in the US and in other countries that have led to these high external imbalances, and we are advocating for urgent action on that. We have been talking about it in various venues. In the US, though, tariffs have a negative supply effect, and this has added to goods inflation, as I just mentioned before, has been a headwind to ever stronger growth. We could have seen more of the good news. Over the longer horizon, the tariffs distort resource allocation, they weigh on productivity. And this is the reason why we encourage the US to work constructively with its trading partners to address these mutual concerns and agree on a coordinated reduction in distortions and trade restrictions that are adding to these global imbalances. Now, let me make a point for the record. As you have seen in the concluding statement, we have not opined on the Supreme Court decision on tariffs, and there is a reason for that. Our standard practice is to finalize the concluding statement and share it with the authorities. This has happened for the US on February 20, roughly a week before the publication today. So what you got today, the authorities got a week ago. And we could not take the implications of that decision into account. Now, this being said, we recognize these are important developments. We are digesting them. We will analyze their economic implications. We will be publishing the staff report for the United States, Article 4, several weeks from now. And of course, we will be publishing a new World Economic Outlook in mid-April. So stay tuned. Anticipate that there will be more on this topic at that time. So let me conclude in the following way. The US economy continues to deliver an impressive performance, and it has proven agile in adapting to shifting policies. The level of private sector-led investment and degree of dynamism and innovation have been impressive. Productivity gains have been broad-based across a number of sectors, and this good news provides an important opportunity for the administration to address the long-standing fiscal imbalance, to further support private sector dynamism through well-calibrated policies, and to work with trade partners to lessen trade distortions. So overall, a good year for the US and an opportunity to do more. Julie, back to you.
Very good. So we will now open the floor for questions. Please, when you're called, give your name and your affiliation. And if you're online, please make sure to turn on your camera and your microphone when and if called on. All right, let's open the floor. David, we'll start with you.
Thank you. Hi, thank you, Madam Georgieva. David Lauder with Reuters here in Washington. You did note some concern about the current account deficit of the U.S. Now, as you know, the Trump administration has switched to a different set of tariffs that are based on dealing with current account or balance of trade problems. So I'm just wondering, does the U.S. currently, in the IMF's estimation, have a large and concerning current account deficit, that would be in line with the language of this particular law? Does the U.S. have a balance of payments crisis? And then, furthermore, just asking you also about the the fiscal trajectory of the U.S., certainly quite a bit above where Secretary Bessent wants it to be. He wants 3% deficits compared to GDP of the U.S. How much time does he have and subsequent administrations have to sort of bring this U.S. Fiscal trajectory into line before we get to a point where things are more prone to crisis? Thank you.
Thank you very much. Good to see you, David. To start with your first question, we have a methodology to assess external positions of our members. And when we apply this methodology to the US, the conclusion is that the current account deficit is too big, just to make it very simple for the audience. And that is recognized by the administration. It has to be addressed. And it is something that we at the fund have been working for quite some time to analyze and provide some inputs. And actually, I'm going to ask in a second Nigel to tell you a little bit more about it. We do recognize the importance of the US to take a path to reducing the debt and deficit. I talked about that. We are now looking, so you have on one side you have the current account deficit, which is too high, and then on the other side you have the federal budget in deficit, and you have debt levels in the United States that have continued to grow. The US is a large economy. As I said, it has proven to be incredibly dynamic. Actually, it is the only advanced economy where we see consistently, year after year, high productivity growth that drives high growth in the country. So it is not an economy where this is a immediate pressing concern. Neither it is an immediate pressing concern to fix in year 26, in year 27. But yes, over time, our recommendation is and continues to be that significant efforts would be necessary. We talk about reducing the deficit in line with Secretary Bessent's aspiration to bring it down to 3%. That would take attention to both raising revenues and managing expenditures. And since we have the luxury of Nigel sitting right next to me, and Nigel has spent how many years on?
Oh, I don't want to.
You don't want to go there. But here is the person who can give you, who can provide you with more details in response to your question.
So,
and to everybody here. Voila, enjoy.
So just to pick up on what Kristalina said, so clearly the US current account deficit is too big. It's not an immediate problem that needs to be solved tomorrow. It's something that we think needs to be solved over the medium term to bring it down to more sustainable levels. And I would just draw the link between what Kristalina said on the fiscal and on the current account. One of the ways to bring the current account down is to address the fiscal problem. If they address the fiscal problem in the US fiscal savings will go down, and that automatically will help reduce the current account deficit. The other thing that could be done in the US, and I think there's some efforts to try and do this in the policy of the new administration, is to try and find ways to increase US household savings. So that could be through more generous tax incentives for retirement plans, saving incentives for education, for children. So there's some efforts to try and do some of that. And then the third thing I would highlight to bring down the US current account deficit actually requires actions in countries outside of the US. And so by those countries, I think as Kristalina said in the opening remarks, by addressing their imbalances, by addressing their distortions that are creating large current account surpluses in those countries, will automatically help reduce the current account deficit in the US as well. So it's a very complicated thing. There's multiple streams to it, but I think this is something that should be done over the medium term, and we'll be pretty consistent over the years in making that case.
Thank you. the floor open. We'll go to Claire at the in the corner in the back.
Thank you. Thank you very much. Claire Jones, Financial Times. Towards the end of the report, you mentioned the strong institutional framework that the US has, and you mentioned that the existing institutional protections and resourcing of some of those institutions needs to be respected and protected. I was wondering if you could just divulge a little bit more on that position and why you made it. You also mentioned 3 organizations. You mentioned Revenue Administration, Financial Oversight, and Economic Statistics. Why those 3, and why the decision to leave monetary policy out, given that there has been some issues raised about the independence of the Fed too? Thank you.
So we know from decades and decades of experience that strong institutions provide the foundation for good policy decisions, especially when it comes down to understanding what is going on in the economy, in other words, collecting data. And we at the fund do a lot to support countries in that regard. Definitely the importance of supervisory authorities to be able to do their job in a way that guarantees their effectiveness. And we know well that independent central banks perform a very important function to provide monetary policy guidance, set the interest rates at the right place, make sure that inflation is expectations are well anchored. So we know that, and in fact, we recently did look into developments in emerging market economies, and it was very rewarding to see how much emerging markets have moved over the last decades in setting up institutions with the right skills and right mandates to do their job. So in that sense, we do believe that it has been in the history of this country that strong institutions support growth, and in the future of this country, of course, that would continue to be the case. So we recognize. I'm actually going to ask Nigel, why did we list those 3? Let's see what's the answer. Actually, you gave me a great question to ask. I wish I had it this morning when we were doing the prep for today.
Okay, so 2 things. One on the Fed, we do earlier on in the statement under the monetary policy, we do recognize that it's very important that Fed's monetary policy decisions remain independent as they currently are, and very focused on maintaining their statutory framework. We chose to separate the Fed and U.S. government as different entities. On the US government, we've seen a very significant reduction in federal employment. Around 15% of the federal workforce has been lost over the past year. We want to make sure that that doesn't have an impact, as Kristalina said, on key functions like regulatory oversight, like statistics agencies. Why those agencies in particular? In part, those are our natural counterparts, as they're the main economics agencies. But I think there's also an aspect that Revenue Administration, statistics agencies, I think in US and elsewhere, often underfunded and very much create a very important public good that we feel should be invested in. So we just wanted to make sure that that wasn't going to be a casualty of the federal downsizing.
And of course, given the role of the US dollar, the Fed is important for US businesses and households, it is also important globally. It has significance for the world economy.
Okay, let's go. We'll go to Jorgelina right here in the front.
Thank you so much, Madam Georgieva. Jorgelina Rosario from Bloomberg. I would like to ask about the specific part of the report that's on immigration policies. The IMF notices that there's an impact on job creation and on growth as well. I would like to ask first if you, as the IMF, has identified any specific sector that is suffering the most because of these immigration policies. And secondly, if in your talks with US authorities, did you have any specific feedback on this? Because of course this is a policy that the administration is leading, so wondering if they have reached out with a different number or different points of view. Thank you so much.
We look at the labor market in the aggregate, so we don't have the attention to specific sectors. And when we look at the labor market on the aggregate, what we see is that demand for labor has gone somewhat down. At the same time, also supply of labor has gone down, and that, in a sense, provides for labor market stability. Unemployment is, as I said, going towards around 4%, which is a good place for this indicator. The US administration looks at immigration also both from the perspective of the economy and from the perspective of national security. And in that context, they are looking at illegal immigration as something that has relevance for national security. We look at that issue strictly from the perspective of what is the balance at the labor market. And I can tell you that this time around it's more difficult to establish that because we simply don't know when we look forward next year, the year after, whether as a result of increase in productivity, and we all recognize that artificial intelligence may have quite a lot to do with that. Perhaps demand for labor would go further down, maybe in some segments of the labor market more than in others. That needs to be ascertained. And then what does it mean in terms of what is happening in supply of labor? Would that be, will we see a point when this is stabilizing at a certain level? And would there be a good match between demand for skills and availability of those skills on the labor market? And that is, for us, for the next year, for the next Article 4, a question we have to get more deeply into. Nigel, you want to add something?
No, that's good.
Okay, very good. We are quickly running out of time, so I'm going to take one more question. I'll go to Abeyi here in the kind of, yep. Abeyi, can you just signal to the, yep, there you go.
Thank you for taking our question. Bayi from AFP News Agency. I just wanted to follow up on the issue of trade restrictions. You mentioned that the U.S. Should work with partners to address concerns and seek a coordinated reduction in trade restrictions. How do you assess the administration's latest move to impose new tariffs, which could go up to 15% for various partners? And in your talks with Secretary Bessent, has he seemed open to this, the IMF's call to narrowly implement restrictions like tariffs on national security grounds moving forward? Like, how has the administration responded also to these concerns? Thank you.
So when we look at the developments in trade, let me make two observations. The first one is that when tariffs were announced in April, that did create some anxiety globally and uncertainty among US trading partners. Since then, there have been agreements reached on bilateral level, and our understanding is that the intention of the administration is to keep that predictability created through agreements, bilateral agreements, to keep it active, to stay with it. While the tariffs for the US partners, for some of them, have been more difficult because of high exposure to exporting the United States. For others, they have been less of an issue because of lower exposure. We can now see that from the announced tariffs in April to what is being collected, it has been, in the interest of countries, a positive development. In other words, what was announced was around 23%. What is now being collected is more in the order of around 10%. And given that the US participation in exports and imports, with the size of the US economy and the big domestic market, is somewhere around 13–14% of US GDP, that means that the impact is more moderate, more muted than in April was expected. We have not yet been able to assess what would be the impact of moving towards a different legal foundation and therefore different tariffs. We don't know what exactly the administration's plans are. We don't know how would partners of the US react. More likely than not, there would be some continuity. So I'm not going to opine on what that may look like. What I would say is that we have seen around the world a fairly strong commitment to keep trading with the US in a defined manner, and also countries to trade with each other. And even more, we have seen more bilateral and plurilateral agreements as a result. My very simple message is that we have been trading as humanity for thousands of years. Trade is like water. You put an obstacle, it goes around it. And it is for a reason, because trade helps us to have globally better allocation of resources, and as a result, get better outcomes for people. So we expect to see that there would be more clarity given by the administration, and we would see in our analysis in the report a couple of weeks from now, and at the spring meetings, more to say.
Very good.
Take one more. There
All
was
right.
this gentleman here. I feel for him. He has been raising his.
All right. Igor, to you.
Thank you so much. Thank you. Igor Nemushyn, News Agency. I have two questions, but let me ask.
So I let you have a question and you want to.
Okay, anyway, I will ask two. So first of all,
Okay.
about private debt. In February, we have seen that private household debt in the US climbed to $18.8 trillion, which is a new record high. From your standpoint, are there any risks for transmitting this issue to the economic to the economic activity, to the economic growth, etc., or it's normal in the US to see constantly growing private household debt? And the second question, the US President Donald Trump has already announced his plan to increase defense budget in 2027 to 1.5 trillion US dollars. From the IMF standpoint, is there any fiscal space for it right now, or the growing of US government debt is the only way forward? Thank you so much.
So to your first question, what we see in the United States in terms of the financial sector, both on the corporate front and in households, is pretty good picture. We need to remember that there are two things in the US. One is how attractive the US is for financial flows from other countries, meaning that the fuel for growth in the US is coming at a high octane. It is coming at a high level. And we don't really see concerns around households being able to serve that level, neither corporations in the US. What we need to recognize is then when you have high level of employment and you have a buoyant economy, productivity going up, that creates space for households to feel more comfortable to spend. You have a job, you earn money, you spend money. To your second question, the US is in a position to fund its spending, its government spending. We, however, do recommend that medium-term attention has to be paid to bring debt and deficit down. When you have investments from the public purse, they also generate spillover impact within the country. Going back to the people that the private debt going up, more jobs, better paying jobs, people spend more. And we need to remember that this also is good for the world as a whole, because a US that grows, has high productivity, grows rapidly, and has the ability to create more opportunities for others, has a positive spillover effect for the rest of the world. This being said, please be careful, look at the deficit and debt levels, bring them down. Nigel?
Yeah, so on the, just an annotation on the private, so you can't just look at the private debt, you have to look at the whole balance sheet of the household sector. And they have a lot of assets that have appreciated in value, both in the financial sector and in housing. That's made, if you look at their balance sheet as a whole, it looks pretty healthy. However, there are some segments that we do concern about, particularly, it's not always the case that the ones with the assets and the ones with the debt are the same households. So, and I would just highlight too, student debt in this country is very high, and it creates a burden, and we see it impacting macro variables like consumption, because people have that burden as a service. And then for lower income households, we're starting to see some strains in their indebtedness. Not anything, I think, particularly unusual for the position in the cycle, in the economic cycle, but still there's some concerns that is becoming more difficult for that segment of the population.
Okay, very good.
Okay.
Igor burned a question for next time when we get together.
All right, very good. So now I will bring the this press briefing to a close. As indicated, we will be entering now the next phase of our U.S. Article 4, which is preparing the staff report for presentation to our board, after which, of course, it will be published and made available to all of you. Thank you so much for joining us, and we wish you all a wonderful rest of your afternoon and evening. Thank you.